Welcome to the Broken Pie Chart podcast, episode number 51. I'm your host, Derek Moore, and today I'm going to be talking about, should investors ever pay attention to so-called market predictions? Why have they been so wrong? Are they really wrong all the time? And really, I'll just cut to the chase. None of this really matters if you're in a strategy that is long the market, being, you own stocks, but you've got downside protection and hedges. So normally, you kind of hide the lead and bury the lead till the end, and the punchline comes in the end. The punchline's going to come in the beginning. It's like, hey, if you looking at CNBC or reading stuff in the newspaper and you're trying to, you're listening to all these people try and predict what's going to happen in the market, the reality is a lot of times they're wrong, and a lot of times not being in the market would have you miss out. Now, most people say, wait a second, just be diversified, have a bunch of different sectors and things like that. Well, diversification fails when you most likely need the most. We saw this in 2008, 2009, when sort of everything went down. And we know that diversification can only really eliminate one of the types of risks. That's the idiosyncratic risk, which of course is tied to single stocks or concentrated risk, where something happens in the positions or the sectors you're in, and that draws everything down. The reality is that's probably less than half the risk. And the other risk is that systematic market risk, something like you saw in, the end of the tech bubble. Although, to be honest with you, the tech bubble really affected the NASDAQ stocks, sort of the tech stocks much more. The Dow Jones and the S&P was not as highly valued and did not sell off as much, but that's a story for another time. But systematic market risk is really where the entire market goes down. But often, I'm asked questions, hey, what do you think the market's going to do? And, I might engage in that conversation, but oftentimes people are wrong. Sometimes they're right, but sometimes they're wrong. And why is it that a lot of people make these predictions? So we'll get into some of that today. And recently this came to light because there was an article that was being passed around. I think it's an analyst at JP Morgan. I'll, of course, link to the article. I think I saw it in marketwatch.com. And what they did was they looked at some of the predictions and, kind of doom and gloom predictions and said, hey, if you would have taken all your money out of stocks and put all your money into something like the U.S. Aggregate Bond Index, what would you have given up? In other words, what would you have trailed the market? And I'll have a couple things to say on this. And to be fair, it's often, not fair to use a point in time, one reference point in time. You don't know if the prognosticator changed their prediction or couched it with other language and things like that. But if you do a Google search, and I was just curious, sort of some of the famous predictions, or really just things that you might have read over the time. And, this is on the bullish side and on the bearish side. Just going back, I kind of Googled and found an article, hilariously wrong stock market predictions. This was put out in 2015. And, they pointed back to in 2008, somebody wrote either a book or an article titled Why It's Different This Time. And they were calling for the Dow 30,000, meaning the Dow to hit 30,000 level. As of the close yesterday, it was sort of hovering around 28,000. And so certainly calling for Dow 30,000 in 2008 turned out to be wrong, right? Other ones are less about specific numbers, but more. I think it was 1988. The article saying Paul Krugman, who writes for the New York Times, he made the statement: the internet will have no impact on investing, and they quoted him as the rate of technological change in computing slows, the number of jobs for IT specialists will decelerate, then actually turn down. 10 years from now, the phrase information economy will sound silly. That obviously didn't turn out to be right. Somebody else said, hey, you know what? This is back in 2003. Netflix is overvalued, and they cited it trading at 200 times earnings. And by the way, I think I haven't checked on this, but Netflix still trades at a pretty high multiple. But this person said, hey, Blockbuster's Film Caddy could really take a bite out of Netflix and its earnings, along with Walmart's DVD service. That certainly didn't come to fruition. And if you're reading something on credit default swaps, of course, if you don't know what credit default swaps are, they came to light in the 2008 financial crisis, and you can Google that. But essentially, credit default swaps were swap transactions, tied a lot of times to mortgage bonds and things like that. But one of the headlines they have here is AIG, who wound up getting bailed out, right? And they had some comments on credit default swaps in 2008. I think this is actually in 2007. And the article quotes here, "It's hard for us without being flippant to even see a scenario with any kind of realm of reason that would see us losing $1 in any of these credit default swap transactions." So, and it goes on and on. Fannie Mae was quoted in 2004 that subprime assets are so riskless that their capital for holding them should be under 2%. Other people kind of said, hey, Google's not a good idea. It's not a long-term thing. Here's another interesting one too, prediction. And this was from Steve Ballmer, the CEO of Microsoft at the time, in the article. He's saying that basically, and nowadays, I think iPhone controls, I think it's over 45% of the smartphone market. But they, in this article, they were saying that he didn't believe that their market share would ever get over 4%. And there's a quote in here. It's not in quotes, but the article seems to indicate Ballmer said this. And he said, my 85-year-old uncle probably will never own an iPod, and I hope we'll get him into a Zune. For those of you who don't know what Zune is referring to, that was Microsoft's music player, their rival to the iPod. But, the point is you can go on and on about, if you read and you go on, there's all sorts of predictions on here. And, as I said recently, MarketWatch, and I'll link to all of this stuff so you can take a look at it. But MarketWatch highlighted a piece that came out. I don't know who the analyst was at J.P. Morgan, but they came out and they said they have this graph, the consequences of listening to the Armageddonist, and this is from 2010 to 2019. And what they did was they looked at the performance impact of shifting $1 from the S&P 500 to the Barclays Aggregate Bond Index. And, of course, that index holds a variety of bonds, corporate bonds, government bonds, different things. AGG is, let's say, the ETF that mirrors that. And, of course, SPY is the ETF that mirrors the S&P 500. So if you want to take a look and see what the holdings are, you can take a look at that. But they came up with this table. And the people they cite are anywhere from Nouriel Roubini, Jeff Gundlach, Marc Faber, David Stockman, Peter Schiff, Carl Icahn, George Soros, Paul Krugman, among others, right? And what is interesting is they kind of look, and some of these predictions go back further than others, but I'm looking at one that was probably from the mid, let's say, between 2010, 2011. And if you had listened and said, hey, get out of the market, it's going to crash, you would have trailed the market by, I think it looks like over 60% by switching to bonds. And it's worth noting that's not switching to cash, which is essentially earning nothing since 2008. That's switching to bonds. And, the U.S. Aggregate Bond Index, although last year was down ever so slightly, we've had certainly more than the rate of inflation. They've had, years where they were in 7% and things like that. So the point is, if you compare it to cash, it would actually be down, or the disparity would be a little bit different. But one of the things that this prediction, they cite this to Roubini, Nouriel Roubini, who wrote a book on black swans, right? He was saying there's some parts of the global economy, they're now at risk of a double-dip recession. From here on, I see things getting worse. It turned out that didn't happen. Other people, there was a prediction, let's see, this one was, I think they were calling for 90%. Where was this one here? There was one that was actually, okay, here it is. This is one in November of 2012. Robert Wiedemer, The data is clear: 50% unemployment, 90% stock market drop, and 100% annual inflation starting in 2013. So other people say, look, we've got a much bigger collapse coming. I'm 100% confident the crisis that we're going to have will be much worse than the one we had in 2008. The crisis is imminent, so this is 2013. I don't think Obama is going to finish his second term without the bottom dropping out, and stock market investors are oblivious to the problem. There's all sorts of ones in here. Somebody else, let's see, Paul Krugman again, right after I think it was overnight after the election in 2016, the futures dropped and then they were up quite a bit the next day. But he was saying, so we're probably looking at a global recession with no end in sight. I suppose we could get lucky somehow, but on economics, as on everything, a terrible thing has just happened. So the reason why I'm sort of reading these is, and to be fair to all of these people, I'm familiar with some of these, or a good portion of these. And, like one of the things, for example, that Peter Schiff would point out was the growing balance sheet from the Fed, easy money, high debt levels, low interest rates, different things like that. And it's interesting too. I mean, you had people, let's say, calling for the demise of housing in the early 2000s, mid 2000s. And even if they were right, they might have gotten the timing wrong. So this isn't to denigrate or to make fun of any of these folks who've made predictions. And as I said, I mean, the article, in fairness to all these folks, I don't know if they ever followed up with any other predictions or what the context is. So in other words, let's say I did a news appearance and somebody said, hey, what do you think about the markets? And I said, I think the markets might drop a little bit or go up a little bit. And, but if they followed up with me 2 days later, maybe something changed and the decision changed. So it's important to be fair to all these folks. But the point is that you're reading things in the news and on CNBC, on Fox Business, on all these places, and a lot of people make predictions. In fact, a lot of times when people have to go on news stations, the news, they want you to make predictions. They want you to say what you think. So it was just kind of interesting, though, and it's the idea of that, and there's more. They even said in the article they could have included, like in, was it 2013, somebody said the U.S. Has gone over the demographic cliff and markets will crash this summer. But that obviously didn't happen. So here's the thing. Predictions, and this is my opinion now, I think predictions really started, people wanting to make predictions. And I think it started after, at least from my memory, kind of that 87 period. And I realized there are people who said things and made predictions, before the Great Recession and before 2008, before, in the 40s, 50s, 20s, whenever it is. But one of the ones, and I'll link to this as well, was the prediction of sort of the 1987 crash. And I remember this because there was an analyst, Elaine Garzarelli, and I'll link to an article. Looks like it's on her website. It's a reprint of a Wall Street Journal article in October of 1987. This would have been after the crash. And according to the article, it comes out and it says that she turned bearish on September 9th, and she appeared on a Moneyline program. Don't remember what channel that was on. That might have been on PBS, or maybe I'm thinking about Wall Street Week, where was it Louis Rukeyser would go around the table and people would make predictions. And by the way, those predictions didn't usually play out, but they asked for them. But one of the things that she said is she issued a bleak forecast that the Dow could drop as much as 1,300 in a week. Back then, that would have been a really, really big move. And of course, the markets were down around 20%. What was it? Around 20% in a day. And so that was kind of a famous call. And, it's one of those things that if you make a famous call and it turns out to be right, then for the rest of your career, you're the person who called the 87 crash or the 2008 recession. The reality is a lot of people make calls. Not all are on CNBC. In fact, in late 2007, I was hosting what was called the Market Huddle for TD Ameritrade. We were kind of heading up the education program there. And during that time, we used to have guests on, and we focused a lot on technical analysis. And we saw on long-term weekly charts what was setting up to be a head and shoulders pattern. And I remember we did I wish it was still up there. I'd link to it, but they've since taken all that content down. But during that program, that webcast that we used to broadcast out, we actually looked at a head and shoulders with myself and a guest who was another technician. And the way that head and shoulders work, if you look at a pattern, it's sort of got like a left shoulder, a head, and a right shoulder. And if it breaks down through what's called the neckline, then the target is the distance between the head and the neckline. You sort of proportion that or plot that downward from where it would break the neckline. And on the weekly charts, which means every bar represents 1 week, that actually put us down. I think it was the high 600s on the S&P. And we just looked at that and said, "But this is absolutely crazy. I mean, this would be like a 55% retracement." And it turned out that was actually the case. And we said that on the broadcast. Of course, I guess if I would have said it on CNBC, I could have written I'd be the person who called a decline. But that's neither here nor there. Pointed, by the way, on these head and shoulders too, and any of these patterns, they're not right all the time. In fact, they're probably not right even 50% of the time. It's all clues. It's breadcrumbs so the market leaves to try and make sort of an educated guess on what's going to happen next. But remember that what I said at the start of this was that all of these predictions, does it really matter if you are in the markets and you have downside protections, something like a floor? True hedges that either go up in value or avoid losses while the market's going down. And, if you just sit there and you read all this stuff and you listen to all these people come on, it can get really disheartening and really sort of emotional for you. But really, if you're hedged, does it matter? I mean, does it really, really matter? Another thing, too, that's interesting, and I mentioned Elaine Garzarelli in 1987. 87 certainly, from a multiple standard deviation move on a single day, that statistically was thought of as absolutely impossible. And, for a market to go down that much in one day. And I went back and I sort of remember this. And I remember actually a lot of people who were out of the market in 87, they stayed maybe in cash or they did something else. And I was just fascinated by I'm always fascinated by looking at historical market returns and things like that. And so I pulled up, there's this JP Morgan on the markets, and I'll link to this as well. And they publish a kind of a column chart, and it gives you just the S&P 500, the index annual returns. So this doesn't include dividends. And for example, year to date, we are up 25% as of, I think, the 25th on the S&P. Last year was down 6%. Of course, that's excluding dividends. But 1987, intra-year, one of the things they do is they have a red dot, and then it tells you what the intra-year decline was. So, for example, this year, we were down as much as 7%. Now we're sitting up 25%. Last year, we were down as much as 20%, and we ended down 6%. So you think about the intra-year declines. 1987, the intra-year decline was 34%. But surprisingly enough, 1987 was actually positive 2%. And when you include dividends, you're probably north of 5% total return on the S&P 500. So even though, let's say somebody predicted it and got it correct, or people didn't predict it, I mean, if you had hedges on, and let's say you had a floor in the portfolio around 8-9% down, are you really that concerned with a movement that far down? And plus, as we've talked about on previous episodes, if you have hedges, you have things that avoid loss or go up in value as the market's declining to offset the losses. you have what's called the hedger's opportunity. So if the markets go down far enough, you actually can cash in those hedges and then look to get additional shares when the market's lower. And just to kind of show you the dichotomy of this, I looked across the spectrum, and I imagine this is probably 2001, maybe around 2002, I think this was. So there were 3 years in a row that it was down, and then it was down negative 23%. The index only, not dividends. And during that year, it had the same intra-year decline of negative 34%. So 87, same intra-year decline of 34%, but in 87, you wound up positive 2, excluding dividends. In, I think this is 2002, you actually were down 23%. In other words, I mean, who really knows, right? But if you have protection on the account, it doesn't really matter quite as much. And so I wanted to do this episode. I saw the article, and anytime I see those articles, it's kind of like, you see the article, hey, if you would have bought Apple in 1981, you'd have, if you put $100 or $1,000 in it, you'd have X number of dollars now. Those are interesting to read, but they're really not informative, and they're really not helpful for investors. Because in 1981, Apple wasn't even in a lot of these indexes. Apple was, the iPhone didn't come out until, I think it was sometime in, 2005, or I forget when it came out. It seems like it was a long time ago, but it really wasn't that much. And so when you read articles that have predictions, or you read articles that show that predictions were really bad, the point is that you shouldn't make a move just because you read something. And, if you have typical standard diversified portfolios with no hedges, no buffers, and we know that all of that, in 2008, the whole market went down. It didn't really matter where you were. But if you've got protection in the account, this takes away sort of that itchy trigger finger to get in or out of the markets, because the important thing is just stay in the markets, be hedged. Markets come down, far enough, you may have an opportunity, the hedger's opportunity to get in for more shares. But trying to read all these predictions is just, and the thing is, with the internet, you have a lot of predictions that now people make, and people can go back and look at those predictions and dig them up. But, look, it's sort of a fool's errand to try and always follow these things. And the other thing I'll say too is a lot of these websites, they know that what they get clicks on is the stuff that scares people. And I don't think it's any secret when markets are down, I've seen, some people have showed me some numbers on this. When markets are down, there's more viewership. So just keep that in mind. But again, be in the market, be hedged. And if you're hedged and you have downside protection, if you take away some of the worst of what you fear, what is it that you fear then, right? So anyway, I thought this episode would be an interesting one to kind of look back. It's I've been getting, people have been emailing me this article, and I thought I'd react to it a little bit. Of course, the last 2 episodes we did, I would encourage you to go back and listen to those. We did that on hedging single stock, concentrated stock positions. You can also go back and listen to the archives. The other thing I would say is that continue to ask you to share the links to these podcasts. I could sit here and waste time and ask you to, like it, rate it, give it 5 stars and all that. But I'd rather just simply ask you to share it with somebody who maybe doesn't know about podcasts. I know that podcasts are certainly gaining in popularity, and a lot of people have them now. I'm not the first. But I would ask you to share these episodes with somebody if you find it valuable and entertaining or informative. And of course, continue. I'd love to get emails from people. You can go to the website, raiserwealth.com. Also, the holidays are coming up, and I encourage, if you're looking for a gift for somebody, my book, Broken Pie Chart, I will link to the Amazon link. It's available on Amazon. It's like there's a Kindle, an e-version, also the hardcover book. But in the book, I actually go through a lot of things with regards to historicals. I talk about the buffered strategies, the hedged equity strategies, and also selling volatility. And one thing I'll just kind of tease a little bit from the book. In one of my chapters, one of the things I looked at was this idea, and I'm sort of critical sometimes of how people rely on historical data so much to try and say that that's going to happen in the future. Like if you're using nominal yields on bonds that were 7, 8, 9, 10% on, let's say, the 10-year treasury and including those in the averages, and now we have low rates, to me, that's just, it's not a great thing because it doesn't really pretend to what the future is going to be. But one of the things I found really interesting, just going back over a number of different time periods in the markets, and the markets run in these cycles, and the cycles can sort of last for 5 years. Sometimes they last for 25 years. And so we think about the average. And 1982 so this is November of 82 to December of 1999, that was a 17-year period. And if you just look at the Dow Jones Industrial Index and you excluding dividends, the cumulative return. So in other words, let's say if you bought the index, I don't remember what the index was in 1982, but you bought the index, let's say at $1,000 in 1982, and let's say it went to $1,500 by 1999. Of course, it went up much more, but that would be a 50% cumulative return. That's not an annualized return, okay? So 82 to 99, that's over 17 years, the cumulative return was up over 1,000%. That is the best period or cycle that I believe we've ever had in history. To put that into perspective, a 5-year period, July of 24 to August of 29, that was 5 years up 294%. 1897 to 1906, 9 years up 148%. And of course, in the way that you look at this, it's sort of a cyclical bull or bear market. And so you're exceeding a prior high. And so not from the bottom in March of 09, but if we look at January of 11 to present, I think we're up, probably over 200%, maybe 300%. Could be right around there. And that's over, what is that? That's over like 8 years or something like that. But we also have these periods where there are many, many years without any cumulative return or next to none. Consider that September of 29 to November of 54, that's 25 years. The cumulative return, not the annualized return, but the point-to-point return over 25 years is a little over 1%, excluding dividends, of course. And then you had the January of 2000 to December of 2010, that's 11 years, pretty much flat. And so just another little note, markets move in these cycles. We don't really know, when you'll be in what cycle or not. That's why I always say, be invested, right? Be hedged as your core holding, and maybe on a certain percentage, you could be looking at other alternatives like selling volatility. But we don't know when these cycles are going to be. But I would also caution everybody from just using the averages, because the averages that you get might not be the average over many, many years, depending upon what cycle you are. And by all means, next time you see a prediction, take it with a grain of salt. If predictions are like elbows, everybody's got one, right? So with that, hopefully everyone has a good start to the holiday season. And of course, go ahead. I'll link to Amazon if you want to take a look at the book Broken Pie Chart, where I go into a lot of historical stuff in the markets, also get into some of the key strategies. I'd encourage you to check that out, and it will make a great Christmas gift in either hardcover or in the ebook. And please share the podcast. All right, folks, with that, we'll call it there. We'll be back next week with another episode.